Hello guys, this is Rydon Academia, and today we'll be looking at the straight line method of calculating depreciation. Now, previously I've dropped a video on the theory aspect of depreciation. You can do well to look at it. So right now we'll be looking at the method of calculating depreciation. The first method we are looking at is our straight line method. Okay? Now in our straight line method, the same amount is charged as depreciation for every year. That is, our depreciation value does not reduce or increase, it's constant for all the years. And we'll be showing you how we derive straight line method, how we derive the depreciation amount for the year, and also the account involved. Okay? Please stay with me. Quickly, we'll be taking the equation if you look at your screen. Alright? So an asset was bought for 10,500 naira, and it's going to last for 5 years, and it has a scrap value of 500 naira. And we are asked to calculate the depreciation rate as well as open the account necessary. So please follow me and let's start. First of all, the cost of our asset, which is our original cost, is equal to 10,500. Okay? Our scrap value is equal to 500 naira. And our estimated useful life is equal to 5 years. That is, this asset is expected to last for 5 years, and the organization has determined that at the end of 5 years they will sell this asset for 500 naira. But originally it was bought at 10,500. Now we are asked to calculate the depreciation using straight line method. So the first thing I will do is to show you the formula. Using the straight line method, the formula is very easy. Now the formula is just the cost of the asset minus our scrap value divided by the estimated useful life, or the number of years. Okay? This will give us our annual depreciation. Like I said, in straight line method, we are charging the same amount. So it means when we do this, we'll be using the answer we get here, the value got in here. We'll be charging it as depreciation for every year. Okay? Alright, our cost of asset is 10,500. And our scrap value is 500 naira. And our estimated useful life is 5 years. Alright, so this is just the formula. This is how we'll be getting our annual depreciation. So if you do this correctly, our answer will be 2,000 naira. That is, for every year our depreciation is 2,000 naira. Against profit, we'll be charging 2,000 naira. The next thing I will be preparing here is our depreciation schedule. Okay? Our depreciation schedule is a table that shows depreciation, the cost of the asset, the years, and as well as our accumulated depreciation. Alright? Now, before I continue quickly, I want to make something clear. There are two methods, generally, there are two methods that are used in calculating depreciation. We have the old method and the new method. Now in our old method, we keep reducing depreciation every year, and the value of our asset continues to reduce as depreciation comes, okay? But in our new method, we make use of accumulated depreciation. That is, the value of our asset remains constant, meanwhile depreciation increases for each year. So I'll be explaining that. For this video, I'll be making use of our new method because it is more easier and it is more accepted. Alright? So our idea is we have 5 years. And our cost of asset, now our naira sign is very important. Our cost of asset, like I said, I'm using our new method. So for every year, cost of asset is 10,500. Okay? Now, for the second part, it's an annual depreciation. Since we are using a straight line method, it means our depreciation is constant. For the 5 years, we'll be having the same amount of depreciation. That's why it's called straight line method. So for every year, our naira sign, we'll be having 2,000 naira. Okay, that's being done. Now we move to the next part of this, which is the accumulated depreciation. Now, accumulated depreciation simply means the depreciation for the year plus the previous years, okay? The depreciation for the year, the present year, plus the depreciation for the previous year. What I really mean is that this year plus the previous year. Now, this is our first year. That means there was no previous year. So, our accumulated depreciation is just 2,000 naira. Okay? Now, in our second year, this is our depreciation for the year. But we have a previous year, okay? So our accumulated depreciation is this year plus the previous year, which will give us 4,000 naira. Now, let's go to our third year. This is our third year. Like I said, this year plus the previous years. Here we have 2 previous years, so we'll be adding them. 2,000, 4,000, 6,000, okay? Same thing here. This is our current year plus the previous years. And this is our last year plus the previous years, okay? That will give us 10,000 naira. Now, in our net book value, for every year, our net book value is simply the cost of the asset minus your accumulated depreciation, not annual. The cost of asset minus your accumulated depreciation, that will give us your net book value for the year. Alright? So for our first year, our naira sign, that will be giving us 8,500. This minus this. So this is our depreciation schedule. So we'll be working with this. Alright? So now I'll quickly prepare all the needed accounts. Now, in preparation of a depreciation account, we have 4 basic accounts to prepare. Our asset account. Second is our profit and loss account. The third is our provision for depreciation account. And the final one is our statement of financial positions. So quickly, I'll be opening the account for every year. Like I said, I'm using the new method, meaning for the asset account, I will just enter the general amount because we believe for every year, our asset value is the same, okay? So now this is our asset account. In this case, a machine account. This is our credit side. This is our debit side, okay? Now this is an asset account. It means like we were taught in our trial balance, we are debiting assets, right? So we'll be entering this on the debit side. Alright, so okay, and this is it. we believe it was bought for cash, although we weren't really specified on that, but we assume it was bought for cash, and that's the entry made. Alright, so this is this for the asset account. Alright, so quickly, we are going to be preparing the next account, which is our profit and loss account. Now in our profit and loss account, depreciation is treated here as an expenses, okay? We treat depreciation as an expenses. That means expenses are usually debited. So we'll be debiting our depreciation amount. That is our accumulated from our depreciation schedule, our annual depreciation, okay? We'll be entering them for every year. For the first year, okay, so this is our profit and loss account, and like I said, we are treating it as an expenses. So this is it. So the third account we'll be preparing now is our provision for depreciation account. Now this account is set aside to receive the values that we are getting from our profit and loss, okay? Like I said, since we are treating this as an expenses, the company opens an extra account to receive this as an income, alright? Because it's the company's income in a way. So this account records depreciation as an income, but from the profit and loss account. So here we'll be crediting our income, but this case should be crediting it with the name profit and loss account, because we are getting that from our profit and loss account. So for the first year, profit and loss account, which is where we are getting our depreciation, alright, at the end of the year, we will need to do a balance carry down, okay? To balance our account. Alright, now for the second year, you can either call it profit and loss in full, or you can also use P and L, okay? For our second year, the balance carry down. Okay, before I bring that, let me bring our balance down. The balance carry down, brought down. Since here is carried down, here will be brought down. So the balance brought down for the second year is the 2,000, which was carried down earlier, then the profit and loss for the year. To give us a total of 4,000. Right? We also balance that. Carry down, sorry. Now for the third year, our balance brought down from the previous year is 4,000, and our profit and loss will as well as balance that. Now for our fourth year, we have a balance brought down from the previous year, which is 6,000 naira. And then we have income from the profit and loss for the year, which is still 2,000 naira. Hope you are following me. We are getting the profit and loss value from here. So for every year, we are getting it from here. So that is 2,000 to add to give us 8,000 naira. We'll be balancing that up as well. Balance carried down. Now I'm closing my account. Okay, for the year. Now for the final year, my balance carried down, my balance brought down is what? 8,000 naira. And also I'm getting income again from profit and loss, which is 2,000 naira. So as well as balance that, my balance carried down is what? Okay, so this is what our provision for depreciation account looks like. Alright, so here we are trying to see our income gotten from the profit and loss account. So lastly, I will be opening our statement of financial position account. Now, our statement of financial position account is also known as your balance sheet. And the function of balance sheet is to review the asset and liability of the business. So we want to be reviewing the asset and liability of our business for the past 5 years. So this is our credit side and our debit side. Now, usually in our balance sheet, our assets are credited, while capital and liabilities are debited. So since our machine is an asset, we'll be entering it here. Okay? So we'll quickly be making entries for year 1. Our assets, which in this case is our machine, I'm making 2 naira sign here because I'll be working with double figures, okay? The first one is our machine value. Like I said, we are using the new method. So meaning for every year, our machine value is the same. But what we'll be charging as depreciation is our accumulated depreciation. Alright? So for the first year, our machine value is 10,500. Now we are lessing depreciation for the first year. From our first year, our accumulated depreciation is how much? 2,000 naira. So we'll less that to get what? 8,500 naira. Now, our second year, our machine account still remain constant because, like I said, we are using the new method. Alright? And we still less what? Depreciation. Like I said, we are lessing accumulated depreciation. So for our second year, accumulated depreciation is 4,000 naira. So we'll let that to have 6,500 naira. For our third year, our machine still remains constant. And we are still lessing depreciation. For our third year, our accumulated depreciation is 6,000 naira. So when we less that, we will have 4,500. We close the account for that year. For our fourth year, for this year, our accumulated depreciation is 8,000 naira. And when we less that, we have 2,500. Now our last year, For the 50, our accumulated is 10,000 naira. When we less that, we arrive at our scrap value. Okay, so that means this money will be recovered when the business sells that asset. And that's that about calculating depreciation using our straight line method. Okay, so please, if this video was helpful, like this video, give us a comment. All right, you can also share with your friends. Don't forget to subscribe. So see